Okay, chapter 9, behavioral finance and technical analysis for behavioral critique of investments in this case. So behavioral finance, the financial markets emphasizing potential implications of psychological factors affecting investor behavior. So really what we're looking at here is, what type of events occur that create a behavioral response in my investors that change the way that they invest and what they do and how they react. And arguably what this means is that there's an existence of irrational investors that is not sufficient to render the capital markets inefficient. So while we believe there are some measurable behavioral financial issues, there's not enough or a high enough quantity of them to render the capital markets inefficient. So we're still based on the efficient market hypothesis here. Okay, information processing. Information processing, this is the part where, okay, when information is gathered for, potential investments, potential trades, what do they do with it, how do they use it, and how do they process it? Forecasting errors. People overvalue recent experience compared to prior belief when forecasting. So oftentimes people forecast more positively if recent experience shows that's the case, rather than what they might derive from the numbers, solely the numbers itself. Overconfidence is another issue with information processes. People can overestimate precision of beliefs or forecasts and overestimate their own abilities, meaning they're not as good at reading this information and using this information as they think they are. Conservatism bias. Investors are too slow in updating beliefs in response to recent evidence. So basically they're not willing to jump the gun. Okay, this is a conservatism bias. I kind of feel like that's really similar to, like Newton's law, where when they're at rest and they have something, they're more willing to stay at rest than they are to change. So investors are usually slow in updating their beliefs and their thought processes. Sample size, neglect, and representativeness. People prone to believe small sample is representative of population and infer patterns too quickly. So when we're looking at studies and academic research, we need to make sure that the size of the population being gathered is large enough to be statistically significant over the entirety of the population, rather than making assumptions based on behavior out of a relatively small population. All right, behavioral biases. Okay, behavioral biases is when we're talking about, even if information were perfect, there's a lot of studies out there that say that individuals would tend to make less than fully rational decisions using that information based on some of these behavioral biases. So the first one is framing. Decisions affected by how choices are posed, i.e. gains relative to a low baseline level or losses relative to a high baseline level. So basically how the decision is framed to them, or how it's given to them, and their level of understanding, framing the information. Mental accounting, form of framing. People segregate certain decisions. For example, an investor may take a lot of risk with one investment account, but establish a very conservative position with another account that's dedicated to his child's education. So, the same investor can have different motivations, different reasons for doing certain things, and even different accounts that they handle in a different way. Another behavioral bias is regret avoidance. People blame themselves for unconventional choices that turn out badly. So they tend to avoid regret by making more conventional decisions. So, making decisions based on data rather than based on, feelings or thoughts, or just things that are not solid and concrete. Prospect theory. The investor's utility depends on gains and losses from starting position rather than levels of wealth. Where they care more about, did I make money or lose money based on where I came in at, they place that on a higher pedestal and make that more important than just how much money they actually have overall. Limitations to arbitrage. Fundamental risk, the market changes or irrationally can eliminate profits. So that's a fundamental risk of investing in the market in the first place. The implementation cost, exploiting overpricing is difficult. Costs and time limits can eliminate profits for implementing. So exploiting it. So you basically got to be real quick about what you're trying to do. And there can be time limits on how fast you need to react to what the market's doing. And then model risk, inaccurate models generating inaccurate stock values. So if you're utilizing a model that is not accurate with what the market is doing, that's the risk involved there for model risk. Prospect theory, behavioral critique again. Prospect theory challenges a conventional view of the relationship between wealth and utility. Utility is a function of change in wealth, the effect of feeling good or bad that a consumer may attach to the potential purchase or investors to a stock. So again, kind of go back to what we talked about a few minutes ago. This is the viewpoint, or the behavioral viewpoint, that we're more inclined to worry more about whether I've got gains or losses individually rather than the overall wealth accumulation that I'm receiving from being in the stock market or investing in the stock market. Okay, so this is a conventional utility function where you can see that utility starts to flatten out after we get to the point of about 10 or 15 where it kind of gets really started to flatten out. So as you pass through 2.0 here on the utility side, it really starts to slow down. And this is just going to show that this prospect theory about utility is a function of the change in wealth, that they view a less or a conventional view of the relationship between wealth and utility. This is the utility function under prospect theory, where our change in wealth, the graph's increasing concave up and passing through its origin and increasing concave in 1. So notice that even when it gets up here, the big difference here is this one is eventually arching down. Okay, it's arching to flat, whereas this is arching up. Okay, and it's arching up at a faster rate, and it tends to increase. So this is the utility function if we're using prospect theory to graph it. All right, another behavioral critique: limits to arbitrage and law of one price. Siamese twin companies, dual-listed companies, can appear to violate the law of one price. So the example it gives in here is in 1907, Royal Dutch Petroleum and Shell Transport merged their operations into one firm. The two original companies, which continued to trade separately, agreed to split all profits from the joint company on a 60-40 basis. Shareholders of Royal Dutch would receive 60% of the cash flow, and Shell would receive 40%. One therefore would expect that Royal Dutch would sell for approximately 1.5 times the price of Shell, but that is not the case. You can see in this is a deviation from the parity. So we've got both of our Royal Dutch and Shell, and the wider the gap, the more different they are. And you can see there's really not much of a difference. They pretty much follow each other. There's not big, broad differences. And there certainly isn't that 1.5 times the difference as it should be, based on the fact that Royal Dutch is receiving 60% of the cash flows and Shell's only receiving 40%. You're really not seeing that. Instead, it's more like they follow one another rather than it be that separation as you would anticipate based on the numbers. All right, equity carve-outs. Very similar to the law of one price. Sorry, this is violated the law of one price. Excuse me. So 3Com in 1999 decided to spin off its Palm division. It first sold 5% of its stake in Palm in an IPO, announcing it would distribute the remaining 95% of Palm shares to 3Com shareholders 6 months later in a spinoff. Each 3Com shareholder received 1.5 shares of Palm in the spinoff. Once Palm shares began trading, but prior to spinoff, the share price of 3Com had been at least 1.5 times that of Palm. After all shares of 3Com entitled the owners to 1.5 shares of Palm, so it makes sense. Stock price moved to being 1.5 times shares of Palm because that's what they were going to receive when the spinoff occurred. But then at the IPO, the Palm shares sold for more than the 3Com shares. So the sub-value of the 3Com shares could be computed as 3Com minus 1.5 times the price of Palm. This calculation implies that 3Com's value was negative, and despite the fact that it was a profitable company with cash assets alone at about $10 per share. So that is one that negates that Siamese twin, where it followed it up until the point of the actual sell-off in the first place. And then when the IPO occurred, that's where the equity carve-out happened. Close-ended funds. So a close-ended fund often sells for substantial discounts or premiums from the net asset value. This is nearly a violation of the law of one price because one would expect the value of the fund to equal the value of the shares that it holds. But that's not necessarily the case. Lear, Schaefer, and Thaler argue that the patterns of the discounts and premiums on closed-ended funds are driven by the change in investor sentiment. They note that discounts on various funds move together and are correlated with the return on small stocks, suggesting that all are affected by a common variation in sentiment. So this is the calculation of the premium of the fund over the net asset value. We have our alpha, or sorry, we have our dividend yield, we have our alpha, and we have our expense ratio. There's that shell chart we already looked at. Bubbles in behavioral economics. So evidence of irrational investor behavior that we've seen in bubbles. This would happen with like the dot-com bubble and other investment bubbles, the real estate bubble that happened in more recent memory. And the problem with these is they're much easier to identify when they're done. They aren't really easy to identify as they're happening, which is why you see a lot of people lose a lot of money in those areas when a recession hits or when something bad happens, economically speaking. That's where you're seeing a lot of big major losses, which is in line with the fact that they had a lot of gains before that, which is where the bubble kind of came from. Evaluating behavioral critique, there's no real coherent theory. There's a lot of different theories that try to explain why people behave the way they do when investing. But most empirical support is from the late 90s, which is interesting because that's the period where there were the most accounting frauds and where there was a lot of other problems going on. Also, that's when the tech bubble, the internet bubble occurred as well. I'm going to stop this video there and continue with chapter 9 in the next video.